Chapter 8 is all about GST, so we've covered that in previous chapters, so let's just have a quick refresher. So if you go to the cafe and buy a Coke for $3, you actually have to pay $3.30, and the 10% extra or the 30 cents represents the goods and services tax, or GST. So the transaction is, you give the cafe $3.30 and they give you a Coke. The $3.30 for the cafe, it's important to realise that's made up of two parts. So $3 that is revenue that they've earned, so it's theirs to keep. And the 30 cents is a GST liability. The cafe actually can't keep that money. It has it at the moment, but eventually it'll have to pay it to the government. And the reason why that is because of the way the GST system was designed to work. So you as a consumer don't give your GST that you pay straight to the government. So when you go to the cafe and pay 30 cents GST, you can't give it to the Australian Tax Office. That's impractical. So instead, you're required to give it to the business from whom you buy from. So in this case, the cafeteria. Then every 90 days, the cafeteria will give the GST to the government. So the point being that there's going to be a period of time where a business holds money in the form of GST from customers that it doesn't belong to it. It's actually going to have to pay it to the government. So how it works is every time the business collects or charges GST, that goes into our pot here and increases our GST liability. In contrast, whenever we pay GST or get charged it by suppliers, that will reduce our GST liability. So a firm will have a GST liability when the amount they collect is more than the amount they pay, and that'll be a liability. So for example, during the month the business collected the following amounts of GST. We've got 100, 300 and 200. So that'll increase the liability up to $600. That's how much the business owes the government. However, you get to offset that with what's been paid. So during the month, the following amounts of 50, 50 and 100 have been paid, so that's a total of 200. So they get to come out, and instead of owing 600, the business will only owe $400. So that'll be a GST liability. So we've collected 600, we've paid 200, and we've got a liability of 400. So looking at where that'll go on the balance sheet, that'll go under as a GST liability and the current liabilities. And we're just looking at why is that a liability in this case, because there's a present obligation. In this case, we've got to repay the government the GST. It arose from past events, which is all the transactions that included GST, and it will result in an outflow of future economic benefits. So in this case, the firm will have to pay cash to the government. The opposite would be when we get a GST refund. So that's when the business collects less GST than it actually pays. So for example, during the month the business collected the following amounts of GST, so we've got 100 and 200, so the liability went up to $300. However, get to offset that with all the GST that's been paid, so in this case 100, 200 and 100. So if we take that back out, that's actually more than we've collected, so we'll end up with a refund of $100. So looking at the maths, we collected 300, but we paid 400. That'll result in a GST refund of $100. Where would that go on the balance sheet? That would go as a current asset, as we're expected to get that money within the next 90 days. Why is it an asset going through the theory? It's a resource controlled by the business. What is the resource? Well, we've got a legal claim for a cash refund from the government. It arose from past events, which was all the transactions that we engaged in that had GST. And lastly, there will be a future economic benefit coming from this asset. In this case, it'll be the actual cash that the business receives from the government. In Australia, our GST is on many transactions, it's 10%. Other countries have a GST, but they use different amounts. So New Zealand would be 15, Japan is 5, and France is 19.6. Thankfully for us, ours is 10, which is pretty easy to calculate. And just remember though, there are some items that don't have GST applied to them. So you can go to the tax office website via the link and find those out. But for our purposes, the most basic ones we'll deal with that don't have GST will be receipts from debtors and payments to creditors. Interest revenue and interest expenses won't have GST. Transactions with the owner, so any capital contributions or drawings won't have any GST. Loan or loan repayments, there's no GST on financial transactions like that. And wages are an expense that don't have GST. The GST, remember, is made up of three amounts. We've got the exclusive amount, the GST of 10%, and what's called the inclusive amount. So, for example, the business paid $300 plus GST for advertising. The exclusive amount is $300, GST is $30, and the inclusive is $330. So when we get given the inclusive amount, we just change our formula a little bit. So in this case, if it's GST of 10%, we take the inclusive amount and divide it by 11 to figure out how much the GST is. So for example, a business paid $484 for rent inclusive of GST. So we know the inclusive amount is $484. We can divide that by 11 and that'll give us GST of $44. So putting back together the equation here, the inclusive amount was $484. Take away the GST of 44, that'll give us an exclusive amount of $440. Some other examples, just to be able to calculate these are quite basic examples, but $700 plus 70 is an inclusive amount of $770. We get given the $1,210 inclusive amount, we need to divide that by 11, and that'll give us GST of $110, and working backwards, the exclusive amount will be $1,100. GST is 10%, which is 50. That must mean the exclusive is 500 and the inclusive is 550. And finally, we've got an inclusive amount of 363. We divide by 11. That'll give us the GST of 33, and that'll give us the exclusive amount of $330.